our second panel discussion that is titled The Institutionalization of Blockchain Staking. In particular, our panelists will be discussing more about decentralizing Ethereum and whether the future is liquid and, last but not least, self-regulating technologies. So let's welcome our moderator, Anndy Lian, NFT from Zero to Hero book author, our panelist, Anuj Shankar, CEO of Luganodes, Igneus Terrenus, Head of Communications and Business Development, Mantle Network, Ken Nizam, Founder and CEO of AsiaTokenFund Group, and Zhuling Chen, CEO of RockX. Everybody, let's give them a very warm welcome.
Hi, good morning, everyone. It's good to see everyone in Singapore. And today we have a lovely panel, and we are going to talk about something a little bit more serious and a little bit maybe more technical. So it's about blockchain crypto staking. So before we start the whole conversation, we will have a round of introduction. Let's start off with Ken.
Morning, everyone. Thank you so much for having me here. So my name is Ken Nizam. I'm the founder and CEO of AsiaTokenFund Group. Also a member of Forbes Council, KOL for Binance and CoinMarketCap. And what we do is we are a venture builder, a VC, as well as a go-to-market agency. I'm based in Singapore with a team of over 35, based all across the world. And we do a lot on crypto investment. So I think this is one of the subject that, really intrigued me. Yeah, thanks.
Hi, good morning, everyone. My name is Zhuling Chen, so I'm the CEO of RockX. So at RockX, we do two things. So for any companies or developers who want to interact or get onto blockchain, we have the access point for you to scale. And once you start to have tokens and you want to generate a self-custodial income, which is staking, we run validators. So yeah, we've been doing this for the past 4 years. It's very excited to be here to share our experience.
Hi everyone, my name is Igneus Terrenus. I'm the public liaison for Mantle. I look after comms and BD stuff. So Mantle is EVM L2 and it's modular and high performance. And we recently just did a brand merger with BitDAO, one of the largest decentralized autonomous organization in the world as well, and inheriting one of the largest on-chain treasury, currently sitting at about 3.8 billion. So our mission is to kind of help the wide adoption of decentralized technologies through our development of the upcoming Mantle L2 as well as a liquid staking derivative product that is coming up. So pretty relevant to the conversation, I guess.
Thanks, Igneus. Hey guys, good morning. I'm Anuj from Luganodes. So I'm the CEO of Luganodes. We are a Swiss-operated non-custodial staking provider. So currently, we are the world's fastest growing staking provider. We manage around 700 million USD worth of staked assets across 22 plus proof of stake networks. So we run validators on each of these, and we also provide a lot of different other infra services to various different blockchains that we work with. So that's like a quick intro.
That's great. So for myself, I wear various hats, but today I'm just a book author. And I have a lot of questions in mind about how staking is going to work, how institutions are taking a bigger role, within this crypto staking environment. Let's start off with the first question. How can institutional investors effectively manage their risk when participating in blockchain staking? What risk management strategies are being used? Any gentlemen who would love to take this question first?
Yeah, I can probably start. So when it comes to managing risks for various institutions, especially when they are participating in staking, usually it starts with the due diligence of the network itself. So when I say due diligence of the network itself, it means things like the security of the chain, the governance of the chain, how it is managed and how it is handled, right? So things like those typically are pretty important. So due diligence is one of the key decisions or key part of the risk metrics that usually institutions take up. Then secondly, diversification when it comes to choosing multiple staking providers, right? So even if one of the providers that they have worked with doesn't work out pretty well, the other ones can always help them diversify their overall choices for staking with multiple people, right? So that's something that usually institutions should typically take care of. Like, for example, when we are working with various custodians, they give the institutions options of staking with multiple providers. So typically, institutions select multiple providers to just diversify the overall risk. So that is number 2, and number 3 is on the overall regulatory compliance, right? So that's something that is always a tricky part, but usually it's always beneficial to be in touch with the regulator and to just check with the staking providers as well as to what is the latest regulatory scheme in the geography in which they are staking. So that's something important to take care of. So these are some of the 3 points that I wanted to mention.
That's good insights.
Yeah.
Ken?
I think the most fundamental is to really understand what the risks are first, before you try to mitigate them. Definitely, when it comes to crypto staking, you know that you're going to lock your funds up for quite a long time. You can be short, but it can be long as well. But for me, there are 3 fundamental risks. Number 1, of course, is crypto volatility. When you stake the prices of crypto, the value of your assets. Number 2 is the security of the network. How well do you know the team behind it, or how stable the network is? You research. How many times has the network been bugged or been hacked? Number 3 is the platform itself. How safe and secure are the platforms? There are no platforms that can guarantee you 100% security. I mean, like FTX collapsed, one of the biggest. So how can the rest ensure that they won't collapse? So these are the 3 big risks there is. Having said that, I think you've spoken about the first 3 points. I would like to add 2 more points I think can be added as an extra layer for mitigating risk. Number 1 would be custodian service. There's quite a lot of custodian services out there. Some are really good and reputable. This adds as an extra layer of protection for your funds, especially if you are new to crypto. Because from the trend that I've been noticing right now that there's a lot of crypto VCs out there. They are experts. They have been there, done that, it's done. But right now, what we're noticing, there's a lot of newer family offices or newer H&W, high net worth, that's coming into the space. They don't want to go through the VC route because they want to profit more, but they don't really understand the fundamental. So I think having a custodian services would be good. And number 3, a bit basic, would be some staking platforms offers insurance. And this insurance can protect you. Again, when we talk about institutional investors, we don't really care about volatility. I mean, we all have risk appetite. Institutions have risk appetite. But the most important is protecting your assets from being hacked, from being bugged, or just loss of assets. So custodial and insurance might play a good role in that. Yeah. So understanding the risk, the 3 factor of risk, the first 3 points, and plus my 2 points. So I think that's quite okay. Yeah.
Sure. Zhuling?
Yeah, maybe just to, I think these 2 gentlemen has covered most of the things, but I'm just going to rephrase it a little bit differently. If you're looking at staking, actually you're looking at a long-term yield that comes from the network itself. So meaning that if you look at Ethereum, for example, as an internet company or even an internet territory, staking yield is basically the sovereignty bond that you're dealing with, right? So just like you're investing in any sovereignty bond, the first thing you look at is the currency risk, meaning that do you believe in this company or do you believe in that economy? So you look at the network activity. You look at how robust the network is. So that's how you draw a conclusion whether you want to do more on Ethereum or you want to do on Polkadot or you want to do Cosmos, etc. Yeah. Then the second thing is just like Ken mentioned, you need to really understand, okay, who is holding your principal, right? That's your asset. Are you entrusting a third party to do it? Are they trustworthy? How are they doing it? Are you comfortable with that, right? Or are you doing it in a self-custodial way? And the third point is that when the rewards is being generated, number 1, who managed that reward for you? Is this directly from the network itself, or somebody is holding that and distribute it to you? This is totally different, from a business model perspective. And of course, the counterparty risk you have is only one, because in this whole business, your principal is always safe, but you don't want to have slash. So that's also similar to what Ken was mentioning. You need to look at, okay, so the staking provider, how they're actually doing, running all the servers. Are they managing their private keys in a secure way? So these are the questions usually you need to ask. And of course, end of the day, this is a very new industry, so diversification is very important. Yeah, especially as you grow. Like, for example, Ignatius has mentioned that, okay, if your asset is above $1 billion, you probably don't want to put everything in one custody or in one staking provider. This is what we have seen in US, because a lot of potential customers are talking to us, because now they're looking at offshore alternatives. They're looking at diversifications.
I guess kind of like I come from like the sort of complementary view, because everyone else here is like an institution looking to stake their funds, whereas we kind of like a service provider. I think everyone said here was like really to the point that you want to kind of like have more knowledge and more kind of like educate yourself better going in. I think a lot of more important is that you don't see it as a transactional. Just a simple transaction, rather build deep foundations and like good relationship, and really kind of find a team that you can trust. I understand kind of trust might be a dirty word in like what's supposed to be a trustless protocol service, but at the end of the day, behind the code and the decentralized protocols, we're dealing with people, and a lot of times like you can still use the due diligence of traditional financial market in this space, especially when dealing with people. It's important that you find, protocols and peoples and teams and, code that you can basically see who are building for the long term, instead of, just going there for the quick buck because there's heightened activity on a particular chain.
Thanks, Igneus. I strongly agree with all the panelists on their points. But maybe following from what Igneus has mentioned, what we talk about could be something that is more trust-driven, right? But of course, there are a lot of zero trust kind of protocol that's in the space, zero knowledge mechanism that involves in the whole staking process. How do you see that kind of mechanism working for institution? Is it much more safer? Do you think is a lot more palatable for institutions to enter the market because of such mechanism? Maybe Zhuling, you can touch on some of this.
Just my personal thought here, right? Staking is not really a new concept. If you look at the proof of work world, there is mining, right? So you have physical machines that secures the network, process the transactions, hence you generate the yield. Staking is basically the new type of mining mechanism in the proof of stake area, right? So now your tokens, together with the server, becomes a virtual mining machine that safeguards Ethereum, and hence you are rewarded for the work you do. Yeah. So, first of all, I just want to make this point. So this is not really an interest that you earn on your capital. In fact, you are doing work, right? This is more to SEC. So they need to understand this is actually your work done and you're rewarded for that. And if you think from a institutional perspective, BTC mining has been very institutionalized. We've seen public listed companies get into mining. We've seen a lot of banks doing, financing into mining. So actually this is a natural extension that people will start to see, so staking is actually, another type of fixed income that comes from the network itself. Yeah. So having that said, so we think institutions are going to understand that, because it's easier to argue that layer 1 tokens are utility tokens compared to whether it's a DeFi token or it's a NFT or something, right? And the second point here is that so once you get into this, how can you make it more secure using new technology? So one particular technology we're looking at is distributed validator technology. So what it means is that we're getting into an era where each servers are not gonna have a full private key. So meaning that even if a provider like us got hacked, nobody can touch the private keys. So there's no security issue anymore. And also this generates a new era. We will be validating the validators with our clients together. We are backing each other up, right? So this improves the performance. This also improves the security level. So this is something that we have been building together with the SSV team for the past 1 year, because we see this is a really important technology that can remove another layer of trust on this whole network. Yeah. So I'm just going to stop here.
Yeah. That's good insights. Igneus, you want to add on?
Yeah, sure. I really like the fact that sort of like this to remind people that when you are staking, you are actively securing the network. So, like if it's a network that, doesn't really have that many users, or, because we're building on L2 and we're actually quite bearish on alt L1s, we really think it's important that, you have a vibrant economy that's already going on. I know we were going to sort of segue into liquid staking later, but the idea is that you want those kind of like derivatives, liquid staking derivatives, or like, your staking rewards to be in an active economy that can be used, that has utility, rather than just kind of like simple rewards, then people are just going to sell it on. If it is like, if the entire purpose of those rewards are that people just can sell it for fiat, then you don't have an internally circulating economy. Then you're not really creating utility, other than kind of like generating some sort of like, very much like DeFi farming rewards. So we really think, DeFi kind of captures so much of attention to people, but the next kind of like area of focus in this is really going to be liquid staking, derivative Fi or LSD Fi, which is something that has utility, that your derivatives can be used for gas, for other usage within like a larger vibrant ecosystem where developers are actively building. Then you don't actually need to just sell it. You actually can accrue it with like value, kind of like always coming back to the hand.
Yeah, absolutely. So coming back to the question, right? So which was around zero trust and zero knowledge. So these mechanisms obviously are the pure reasons why we are sitting in this conference as well, because the whole space preaches about how do we create trustless systems, right? The reason why Web3 came about was, the sole reason of people not being able to trust this one singular central party, right? So in order to distribute the power, these technologies have been built out. And obviously, as any technology, these are not foolproof, right? There are always risks and there are always loopholes in each of these technologies. But as we see this industry progressing, we are able to, see solid teams building on this particular zero knowledge proof and zero trust technologies. Just to quote some examples, Polygon ZK EVM, or the for example, the ZK Sync team is also working on something pretty innovative as well, right? So these are the kind of technology that's going to prevail in the longer run, because we see the power shifting from the centralized bodies to these decentralized systems that people are working towards and building. So definitely institutions need to also level up and come and participate in these type of systems where the network is not just owned by a few people, but rather masses of people, and the transactions that are happening on the network are more seamless when you have like non-decentralized control over it. So that's just to add on the overall zero trust and zero knowledge mechanism.
Thank you.
Yeah, I totally agree. What Anuj said, that the network should have more people coming in to validate. I think this is the fundamentals of what staking is. It's not just for you to put your crypto there and yield. It actually contributes to the network itself, to the security itself. When a validator stake or lock up their funds, it ensures that they don't do malicious acts or be a bad player, or else their funds will get slashed, right? So I think this is quite important. So again, setting up or being a validator itself is not as simple as it is, because you have to have technical knowledge. Setting it up, maintaining it takes a lot of works, and even if you are not doing some malicious act, but just doing a simple technical mistake, they might still slash your assets, right? But I think these are the securities that it is important. But again, when you talk about institutional validators, for example, Ethereum itself, you need to stake at least 32 ETH, which is about $60,000. But again, currently there are over 230,000 validators times 32 ETH. That's how much you get. So I think that there needs to be a mechanism to make it more secure. But I think to get more people in, especially institutional, and right now at the age where there's a lot of newer people or newer, let's say, family officers or newer high net worth coming in, they need to make the process more simple. Because if you deep dive and talk all technical, how many people out there with a lot of money knows or bothers to do a lot of technical research? They probably have money, but they want something simple and secure. So I think that's what blockchain is supposed to be. You want to have a mass adoption, keep the technical complexity to the tech people, to MIT and whatnot. But you need to adopt the billion people who probably don't have technical knowledge, but they have the resources for it. So make it simple and foolproof, but secure at the same time. Yeah.
That's great.
Sorry,
great
if I may just add one point, because
No
I think Ken had a fantastic point. Because now we're talking about institutionalization, right? So number one, the easiness of using that technology is really important. If you're going to a board decision and you're not really trying to make everyone understand what is decentralization. Actually, they're going to ask you two questions. They're going to ask, if something goes wrong, who should I call? Who holds the counterparty liability? That's the reason why, as a company who serves institutions, we do need to work on, the entity side as well as the legal side. We need to be very clear on, okay, what are the things that we are managing? What are the risks we are holding? That's very important. And secondly, we need to make sure that, okay, we tell the institutions, okay, if you want to stake, it's basically a 3 steps operation. And this only involves your IT team and doesn't require 24/7 monitoring, etc. Then we also need to tell their finance team, hey, we have a dashboard that actually helps you to track your reward every day, so you can explain to your auditor, where does that additional revenue come from? These things, 2 years ago, we don't have that because we're talking to developers. We're talking to, the blockchain foundations. They don't need that education or they don't need that assistance. But now as the industry gets more mature, all those things comes. That makes everyone super busy right now. Yeah.
Trust me, I deal with a lot of institutions. They would prefer to call Satoshi or Vitalik directly to get answers. But that's a separate thing. But again, flowing from the current topic, 2 weeks ago I was in Monaco. I met up with one of the private bank. So they say that, so there's one segment, of the private bank. They say, I have an AUM of about 30 B, sorry. They say, maybe we will put in about 10%, into the crypto business. Then the next question they ask is, if today I'm going to put that kind of money in, what kind of returns can I get? And then while talking, at Monaco, there are other sports team who came by and said, so how can you or the platforms incentivize us to come in? Is it really that safe? So maybe my question is, how can we think of some angle that can really incentivize institutions with serious money to really come in and put in some serious good liquidity, to the whole staking process? What kind of incentive can we look at?
Yeah, probably I can quickly start. So I think just to add to what Zhuling just mentioned, which is more around customized staking, right? So giving them the flexibility of the amount that they can stake. So let's start with that, right? So currently there is a problem of, in Ethereum staking, for example, you need minimum 32 Ethereum to be staked, and usually this capital cannot be pooled very easily, right? But there are a few mechanisms, like for example, liquid staking through Lido, Rocket Pool, and the others who have built this solution can be used. So one piece of the puzzle is basically, do you have enough flexibility in terms of staking the asset that you have? Second is around, the overall solutions to manage your earnings, right? So what Zhuling just mentioned, is the staking provider or the provider that you're working with able to provide you with insights on your earnings? So right now, it's such a fragmented space that, let's say you are staking 5 different assets, it becomes very hard for you to track, how much you are actually making on various different protocol staking that you are doing, right? So using some sort of a reporting mechanism or a dashboard where people can see their overall earnings on a daily, monthly, yearly basis so that they can easily get their books also financially audited by their auditors, right? So that becomes much easier for them to convince them to stake as well. Then the other point that also Ken mentioned previously was around slashing insurance. So giving them the overall comfort on the asset itself, right? So that they become more comfortable when they are staking. And they don't think about the principal loss itself, right? So educating them on why slashing occurs, what are the different scenarios, and then how a provider can protect them from those scenarios is something that is pretty critical as well. And there are a bunch of different slashing insurance providers now, and we are seeing more and more institutional slashing insurance providers coming in. For example, Munich Re has also started pairing up with this company called Chainproof, and they have been rolling out slashing insurances for staking providers to procure, right? So that is something that is instrumental happening in this industry already, and people are acknowledging this. Last 2 years, people, as Zhuling mentioned, didn't care much because it was just developers who were dealing with the overall protocol staking. But now, since institutions wants to come in, they look for how do they protect their principal, how do they get a stable yield. Because I face this question every time whenever I'm facing an institution. The first question I get is, what is the return that you're going to give? It's very hard to predict because we are into non-custodial staking, and the way the yield is also calculated is very non-traditional, right? It depends on the overall staking activity that is happening on the chain. So you cannot. The answer is not like 8% or 7% or 6%. These numbers keep varying based on the overall activity on chain, right? So these type of toolings always help to onboard institutions much easily. And then also as an organization, if you are able to provide some comfort around the security audits, right? So getting yourself as a business audited for ISO 27001 or maybe SOC 2 Type 2, or getting yourself compliant on these different security audit parameters usually help them and give them a better comfort on staking as well, because you have proven to them that from a security standpoint you have taken the right set of measures in order to avoid the slashing risks, right?
This is nice. How about from a mentor perspective?
I think one thing that we would start to kind of invite, those people who are looking, institutions who are looking at it, to take a more long-term view instead of just kind of seeing it as, interest-bearing financial instrument or like a bond. Rather, like staking, you're also staking, your institution into this part of future technology that will see more adoption. And it's a fast-moving landscape as well. Like before the Chappelle upgrade, like by staking on the Beacon chain, you're actually locking up your capital, and then you basically can't withdraw it. But currently the largest kind of staking pools, you have Lido, you have Rocket Pool, and then Coinbase, Kraken both have their custodial staking products. But with the Chappelle upgrade, now you can withdraw. Now you no longer need an oracle to facilitate the withdrawal. Now, basically, you can pre-sign a transaction when you opt in already to close it. And then when you want to withdraw, you can just enact that pre-signed transaction. So it's a fast-moving industry, just like what you said. Like basically a couple of years ago, people were only talking to developers, but now you kind of see more and more those kind of like more customer-friendly approach when it really is like inviting everyone in. So I think it's just kind of like it does reward participants when they educate themselves, and then those family offices, those institutions, they should probably hire at least one or two experts, engineers who actually understand or who have had actual hands-on experience in building kind of like those protocols, so that not only is this kind of like, a hedge, like alternative investment, but it's also kind of like, this thing is going to be big. Everyone, like, I think more or less everyone has arrived at somewhat a consensus. This is something that's going to only go up only in the future. So it might be, a good idea to already stake a part of your future with it, instead of just seeing it as a 8% a year return bond.
Good, Zhuling?
Yeah, just my personal experience. Institutions need less of incentives, but more of assurance, right? They're more looking at the downside before we start to talk about the upside. So having that said, one of the things that, when we talk about staking is that you have two ways to do that. One way is that you own all those nodes or validators yourself. So meaning that those all belong to you. Or you can mix up with others, which is more like liquid staking, right? Each comes its own merit. But for institutions, one thing you need to ask yourself is that, am I comfortable with mixing my assets with others? Or can I actually explain to my compliance, because that is not KYC'd. But of course, in the future, there will be KYC protocols. So for example, what we build is actually a KYC model. For liquid staking, we think that's more suitable for institutions. But this is one consideration they need to look at, right? Then the other thing here is that then you need to look at, okay, in terms of partners or those validators, in terms of the technical design, can you actually explain internally or get your buy-in that this is something that you think you own it, right? We do think just like, when people start to get into cloud, this is into servers, it's always about their own servers first, then cloud, then maybe in the future it's more of a hybrid. So we are more focusing on working on the assurance to institutions, and we think the time will come, once, because their customers are actually pushing them. They're calling them up. Why you are not trying that, right? So they do have a urge of doing something, but now we're just trying to eliminate that concern at the back of their head.
Yeah, I think everyone have answered it perfectly. I think just to add one note only, I think the most important thing that, institution, be it institution or retail, investors, having into consideration is always about the security, not really about the rewards. Rewards, yes, is quite straightforward. Token value, volatility is also quite straightforward, but the security it is. Having gone through the past few months where a lot of crypto companies collapse, a lot of, with the likes of 3AC, FTX, and right now Kraken, Binance, Coinbase having issues with SEC. So the sense of security for investors, not only to, let's say, put the asset on the exchange to trade, it's already worrisome, yet alone to lock it up for a few months on that platform himself, not knowing whether the SEC is going to shut them down and the fund's going to get frozen or the platform just going to get collapsed. And again, in the crypto space, you hardly win any legal battles, unless you spend a lot of money. Then to win a legal battle is not even worth it. So having a trustworthy platform, again, is just words. Having audits is just words. Knowing who's behind it, you never know who they are. They can be big billionaires, but they can still be out there scamming you, shutting down the system and stuff. But again, basic fundamental, they should have in the system, for example, custodians, insurance. I think these are very important to safeguard, especially for new institutions. So again, referencing the traditional banking that gives you a sense of assurance, I think blockchain should also give you the sense of assurance through these two ways.
All right, we still have a little bit of time. Just one final round, for everybody. Quick words, maybe 30 seconds. Just give your last few words before we end the whole session.
Yeah. So just to end, give my quick thoughts. We are definitely seeing a lot of institutions get into crypto staking. That is for sure. We are getting in a lot of requests from various different VCs, hedge funds, crypto custodians and whatnot to get involved in this conversation of staking itself. And the volume of the capital that is also coming in is very, very high. So that's just a good sign. And obviously we have seen players like JP Morgan, players like the traditional banking systems, also getting onboarded in general into the space. So we are just yet to see when they start participating in the overall staking ecosystem and accelerate the overall, the security of the blockchain, which is why the staking first came into the picture. So that's the...
Yeah, I think for institutions coming in with like little or no experience, it's good to find like a centralized platform and someone who helps sort of like as a custodian partner. But as they get more comfortable, as they kind of like accumulate more experience, it's always good to look at kind of like decentralized permissionless code basically like that is open source. Then you can actually audit it, you can actually have your own team run it, and then you can have a test environment. Because when it's kind of like objectively there, it's just algorithm. Then you can actually cut through a lot of the noise and then really find where value is, where participation can really be scalable instead of when you're dealing with the meat factor, the human factor. There's always the bottleneck of how many labor, how intensive the whole operation is.
Yeah. So what has happened last year is definitely is alarming to the institutions, right? If they look at how many assets were wiped out, how many companies were wiped out. But just to set the record straight, what happened last year was mostly on the centralized crypto entities, right? It was a clear lack of risk control, and that's what we should learn about it. But if you look at the technology itself, it's still working. Staking does not fail last year. It was more on the like exchanges, custodies, lenders. And second thing is that crypto space is big enough right now. You can either look at it as a financial infrastructure, but you can also look at it as a new internet. But regardless, blockchain is the one that empowers all of them, and staking is the fundamental mechanism, or we are the ones that actually operates the blockchains to make sure that it's safe, right? So this is the first time, actually exciting, that by operating the blockchains, you are rewarded with a yield. Yeah, so that for any institutions, this is an opportunity, number one, from a technology perspective, and also take the yield as a financial opportunity. I think there are so many things people can do with that.
I think the best part about staking that I really love, besides securing the network, validating it, I think it's more towards when you stake, you are actually reducing. Think about it, you're actually reducing the token supply. Thus, you're actually, in the end, creating this more of a like stabilized or increasing value of the tokens. So the more we get institutions to stake, the more supplies of the tokens limited, and the value just gets better. And we can see slightly more bullish market comes ahead, especially with a lot of staking platform, popping up and a lot of institutions actually joining and staking. So this might be one of the way that we could, finally get off the bearish market or even stabilize the market, That's the beauty of it. But again, for everyone, especially be it institutional or retail, know your risks, do some due diligence, and always invest what you are willing to lose. And that's about it.
My final words is more practical. When we talk about big institutions and so forth, I think one point that Zhuling has mentioned is that it will be fantastic if you can get an in-house expert, to make sure that you really know what you are talking about. Because on a personal side, we deal with some big brands, that there's looking at activating Web3, for example. It's going to be very tough because the legal guys will not understand what we are trying to do. And then if you are talking about staking from an institution standpoint, 100%, we need expert in-house to make sure that they are well protected. With that, thanks everybody. Great panel today. Thank you.
Thanks.